Hi everyone, you're welcome to today's class. Abdurrahman Adil is my name. So in the last class, we started the topic investment decision. So, and also where we define investment as any expenditure in which you expect a certain flow, a certain stream of income from such expenditure. Investment is an expenditure in which you expect a return, a stream of return from such expenditure. Then we say we have capital investment, this is capital expenditure. Also we have what? Revenue expenditure. So we said that capital investment or capital expenditure, as the case may be, involve huge capital outlay, and it spans over a period of time, a long period of time. An investment, it is a lifeline of what, of the business, of the business. That is, it is what you do, it is what you engage on that maximizes what the shareholders fund in the long run. So by that, therefore, we also discussed that before you engage or before you go into any investment, you have to critically appraise such investment. You have to critically analyze such investment, whether you should go ahead to invest, to put your money in such investment or not. By that, therefore, we said we have basically two methods of appraising our investments. We have the traditional method and we have the modern method, which is the discounted cash flow method. And I also said the major difference between the traditional method and the discounted cash flow method is the traditional method fails to incorporate the time value of money, while the discounted cash flow method incorporates the time value of money. Likewise, also under the traditional method, I said that we have two methods under the traditional method, which are the payback period and the accounting rate of return. While under the discounted cash flow, we have the discounted payback period. We have the net present value, which we know as the NPV. We have the net terminal value. We have the internal rate of return. And under the internal rate of return, we have the modified internal rate of return. Also, we have the profitability index, in which we also call it the benefit cost ratio. Having analyzed the appraisal techniques that we have, or the investment appraisal techniques that we have, now we are going to examine each of these appraisal techniques one after the other. Under the traditional method, I said that we have two methods under it, which are the payback period and the accounting rate of return. So today we're going to start with the payback period. The payback period examines the number of the period in which you are going to recoup your investment, the money you have invested on the particular investment. What time am I going to see that money? What am I going to do? What recoup my investment, the money I've invested? What time? What is the time period in which am I going to do what? Get back my fund, my money. So therefore, the payback period refers to the payoff period or capital recovery period. Can you hear that? It refers to the payoff period or capital recovery period. It is defined as the number of years required to recover the cost of the investment. As simple as that. That is, it is defined as the number of years required to recover the cost of the investment. That cost, the money you put on such investment, the number of time, the number of period to recoup it. That is what I mean by the payback period. Payback. When you do this investment, pay me back my money. That's what I mean by payback period. And under the payback period, we have three scenarios in which you are going to examine under it. Number one scenario is what? Where the annual cash inflow are in annuity form. In my previous videos, I've talked about advance of finance, where we discussed what annuity. We said annuity is a constant receipt or payment made at a specific period. At a specific period. A constant, look at that word, it must be a constant receipt or payment made at what? As a specific period. It can be wages, salaries, higher purchase value, higher purchase. It can also be what? Insurance premium. Higher purchase premium, insurance premium. These are constant money that you are paying. Okay, so by that, if the cash flow you are going to see from an investment is an annuity form, that is, you are going to see the same value. You are going to be receiving the same value year in, year out. That's done by annuity. Now, that is constant. So the formula to use under such scenario is what? To payback period is equal to initial outlay, the money you invested, divided by the annual cash flow. Multiply by what? Number of years, divided by in years. We are going to express this what? The answer you're going to have here, we are going to express this in what? In years. In terms of years. So this is one scenario under our payback period. Another scenario in which we can tend to do what? Calculate payback period is what? Where the annual cash inflow are not constant. That is, you don't have a constant cash flow, annual cash inflow. The cumulative cash flow are used to calculate the payback period. The cumulative, you had the cash inflow together, you had then the cumulative, so it's a cumulative you had. So are then used to do what? To calculate your payback period. The third scenario is payback period with bailout factors. This is where estimate of what? Trade-in value for each of the remaining years of an asset is given. Such estimates should be considered when calculating payback period. What by trading value? Trading value can also be known as what? Realizable value or what? To scrap value. So if you are given the scrap value that asset can be disposed of every year, year in, year out, at the end of year one, they give you what? The value at which that asset can be disposed of. In year two, the value at which it can be disposed of. Year three, and on and on like that. So you are going to consider the trading value of such an asset in calculating your what? In calculating your payback period. That's what we mean by what? Payback period with bailout factor. All these I've said now, we are going to do what? We are going to practicalize it, take question on them, and do what to, and see how we are going to use. We are going to do what? Calculate our payback period in each of these scenarios. So by then you are going to do what? Understand better what I'm talking about here. So we are going to do that now. So having said that, let me rub it off so that we can take our question. Let me rub it off. And let's take the question. Let's take question. So the first scenario, question 1, example. Example. Okay. So let's say the cash inflow from an investment which cost 500,000 naira, 500,000 naira, as follows. So let's say our years, cash flow, cash inflow. So year 1, 2, 3, 4, 5. So for year 1, we have 145,000. So all true, 145. Okay. Determine the payback period. Now, in this question now, looking at this question reads us, the cash inflow from an investment which cost 500,000 naira as follows. Years 1, 2, 3, 4, 5. We have the cash inflows. We have what? 145,000 true, 145,500. Okay, 145,500. 145,500. Okay, 145,500. 145,500. Okay, yes. We have it to be what? 145,500, 145,500 true, 145,500 true. So determine the payback period. Here we want to exemplify the first scenario which I cited the other time, where you are going to have a constant cash inflow, where the cash flow are in analytic form. So then we said I divided the payback period to be what is equal to initial outlay all over annual cash flow. Outlay is the money you invested. Outlay is the money invested in the business, on the investment. Okay? The money invested on that, on the asset, as the case may be. So here we have 500,000. 500,000 naira was invested, was the amount invested. All over the annual cash flow, cash inflow is what? 145,000. 145,500. Rather. 145,500. This is annual cash inflow. 145,500. Why do we choose one of it? Because they are the same. 145,500 true. So just pick one value that is us. We are happy about what's annual cash flow. So when you now divide that, when you divide 1,500, let's bring out a calculator. 500 divided by 145,500. We're going to have 3.434. 3.44 when you approximate 3.44 years. Yes, 3.44 years. So approximately we're going to have 3 years, 4 months, and some few days. So this is it. This is how to calculate payback period when the cash inflows are in analytic form. So your outlay, initial outlay, all about what? Annual cash inflow. So that is it. That is that. So that is how to calculate the payback period when you have it in analytic form. Okay. Having said this, let's look at another example to exemplify the second scenario. Let's exemplify the second scenario. Now example 2. Example 2. Suppose an investment of 601,000. Okay, 601,000 will have the following cash inflow. Determine the payback period. Okay. So here, cash inflow. You have 1, 2, 3, 4, 5. The cash inflow are 205,000. Okay, 195, 175, 500, 150,000, and 120,000. Now this is the case we have here. So on this note, we want to, as we can see, the cash inflow given to us in this question, the cash inflows are not in annuity form. The cash inflows for each of these years are not in for each of these years are not in annuity form. That is, they are not constant. So in this case, what we are going to do is just to cumulate it. So you draw it up. So your year cash flow. So you have your cumulative cash flow. So here we are going to start with year 0. Year 0 is your year of investment. How much we invested? We invested 601,000. So let it be in parentheses, that is to show that money is going out. Invested this. So under the cumulative, we are still going to have it at 601,000 there. In parentheses, showing that the money is an outflow. So in year 1, you have inflow of what? 205,000. 205,000. So we are going to less this 205,000 from what? From our investments. So let's compute that. So 601,000 minus 205,000. So 601. So we have 396,000. Okay, 396,000 in jacket. That is, this is the money that we are still from our investment. This is what we are still left to realize. So in year 2, we have an inflow of what? 195. 195, we deduct this 195 from the balance here, minus 195,000. We have 201. 201,000. Okay, in year 3, we have 175 inflow, 175,500 as inflow. So you less it from what we have there, minus 175,500. Okay, we have 25,500. 25,500. 500. That's what we have left. So in year 4, we have an inflow of 150,000. 150. Now, looking at this inflow, okay, let's complete it. In year 5, we have 120,000. We're going to have year 5, we're going to have 120,000. But when you now look at this balance here that we are left to recoup from our investment, you can see is what is not more, is not up to the what to the investment to our return in year 4. That is, our inflow in year 4 is more than what we are left to recoup from our investment. What that is telling us is that we shouldn't wait till the end of the year that we'll have been able to recoup this money before the end of the year, because it is assumed that all this cash flow will flow to the company at the end of the year. Cash flow are assumed to do what to accrue at the end of the year. So therefore, it's within the year that we will have been able to do what to recoup the balance of this 25,500 from this end 150,000. That is, it will not be up to the end of the year before we recoup our balance here. So in this scenario, if the balance to recoup is not up to the what, or is not up to the inflow that you are going to see in the following year, in the following year, it means we are going to do or recoup our money before the end of the year. So therefore, we have been able to do what? So from there, we will do what? To calculate our payback period. Our payback period now will now be what? 1, 2, 3. So we have been able to do what? After year 3, we recoup this. So in year 3 plus what? Plus some few months in year 4. That's when we are going to do what? Recoup our investments. So therefore, our payback period at this point, payback period will now be equals to 3. That's 3.3 plus, okay? Let's just say plus 3 years plus. So the balance here, 25,500 all over here. The cash inflow, 150,000. So by that, we are going to have 3 years, 3 points. So when you divide 25 divided by 150,000, that is 17. So that is 3.17 what? Years. So our payback period is what? 3.17 years. 3.17 years. That is our payback period in this scenario. 3.17 years. So, since it is not clear there, let me raise it up here. So let me raise it up so that you can see it clearly. So our payback period is equal to the 3 years. So 3 years plus 25,500 all over 150,000. So in answer is equal to 3.17 years. 3.17. So we're going to divide 25,500 divided by 150. So yes, 3.17 years. So that is what? This is the time in which you are going to do what? That is the period in which you are going to realize our investment. Okay, having exemplified the second scenario too, let's now look at the third scenario. Let's look at the third scenario. There is it. We have it now. So in the third scenario, let's run this. Example 3. So given the following information about an investment, advice on the payback period. Okay, so let's say this is the information we have. They are given in years. Okay, year, cash flow, cash inflow. Okay, cash flow, let's call it cash flows. And what? Realizable value. So years we have 0, 1, 2, 3, 4, 5. In year 0, the cash flow for year 0 is what? Is 50,000. 50,000 in jackets. In year 1, we have 15,000. Year 2, we have 30,000. Year 3, we have 10,000. 10,000. Year 4, we have 5,000. Year 5, we have 2,000. We have 2,000. So the realizable value in year 1, nil. Year 2, 30,000. Year 3, 20,000. Year 3, 10,000. Year 4, 5,000. Year 5, nil. Now, this is another scenario under payback period, which is known as what? The payback period with bailout factor. The question goes thus: given the following information about an investment, advice on the payback period. So, the information given to us is what? As follows. Here we have year 0, 1, 2, 3, 4, 5. The cash flows are what? In year 0, 50,000. Year 0 is year of investment. That is where you are when you are investing. So it's in parentheses, that is telling us that the money is going out. That is, we are investing. So the cash inflow thereafter is what? 15,000, 10,000, 10,000, 5,000, and 2,000. What realizable value we have then in this form? So if that is the case, okay, so the realizable value after year 1, okay, in year 0, okay, yes, very correct. So in year 0, there's no realizable value. That is where we started. So after year 1, there is a realizable value, year 2, and so on and so forth. So we are now asked to do what? To advise on the payback period. To advise on the payback period. Now, when advising on payback period, in the case whereby we have bailout factor, we have to consider the realizable value. We have to test each of the years. Now, this you have to evaluate the project every year to know when it is when you can dispose of the asset. That is, when you dispose of the asset in year 1, is it profitable? That is, will you be able to do what? Is it advisable? Is it laudable? That is, are we be able to do what? To recoup? You know, payback period is, you are already determining when you are going to do what? Recoup back our investments. So, if you want to know whether if I dispose of this assets after the end of of year 1, will I have been able to do what? Will I have been able to do what? To recoup back my investments. With the investment, the inflow from investment from the scrap value or reserve value, as the case may be, will I have been able to do what? To cover for my investment. As simple as that. Because payback period, they are only treating when is it the right time for me to do what? When am I going to do what? Recoup my investment. In such scenario, let's now test whether if we dispose of the assets at the end of year 1, whether we are going to do what? To recoup our assets, to recoup our investment rather. So solution now. So what we are going to have is what? Year, that is year 0, which is what? 50,000 naira. That is your investment. That's what you have invested. 50,000. Invested 50,000. So therefore, if I now decide to do what? Let me now test. If I decide to do what? To recoup to dispose of this investment at the end of year 1, will I be able to do what? To recoup my investment, the money I've invested. So let's now see the inflow from it, year 1. So inflow from it is what? The cash inflow is 15,000 naira. The realizable value after year 1 is what? What they have is 30,000. 30. So we had the two together and we extend it here, that's 45. So it means at the end of year 1, there will be an inflow of 15,000, and if I decide to do what? To dispose of the asset at the end of year 1, this is the realizable value. So we have the two together, so we have what? 5,000. That is what I will be left to do or to recoup is what? Is 5,000. So it means that this 5,000, I may not wait till the end of what? Of year 2. Before I can do what? To recoup my investment. That is to say, it's just a matter of what? To don't dispose immediately after year 1, but spend some few months in year 2 and do what? And dispose of the asset, in which it is assumed that you will still be able to do what? To dispose of the asset at what? At that reserve value at the end of year 1. So therefore, if I decide to do what? To dispose of this asset in this year, it means my payback period will be equals to 1 plus 5,000 all over. What is the cash inflow for year 2? Is 30,000. So 1, that will now give us what? 1.06. Okay. 5 divided by 30. Okay, 1.1. Okay, 1.6. Okay, 1.17. Okay, so it means I should do what? Wait for what? 1 month and few days. I should let the asset work for me for what? For 1 month and 2 days. And few days rather, and few days. So at least after 1 year, I should not dispose of the asset. I should let the asset work for me for 1 month and what? Few days. So by that, therefore, I would have been able to do what? Recoup my investment. So this now assume that at the end of this period, at the end of what? 1.17 years, I will still be able to do what? To dispose of this asset at this rate of 30,000 naira. So that is what we call what? Bailout factor, payback period with bailout factor. Let's now assume that this value I have here is more than the cash inflow at the end of what? Of this period of year 2. So in that case, it means it will not be advisable for me to do what? To dispose of the assets, to discontinue usage of the assets at the end of year 1. So I need to do what? To wait till the end of what? Year 2. Consider cash inflow for what? For year 1 and year 2. And also consider what? The net present value at the end of year 2. I have to put that into consideration. That is to say, what I'm trying to say is this assets I'm having here, this investment I still need to recoup is more than the cash inflow at the end of year 2. You know, here is more than, it's less than the cash inflow at the end of year 2. That's what I'm going to separate here. But in the case whereby the cash, my investment is still more than the cash inflow at the end of year 2. It means that I will consider the cash inflow in year 1, consider the cash inflow in year 2, and what to consider the realizable value in year 2, at the end of year 2. So I'm going to sum up this plus this in order for me to be able to do what? To determine whether it will be advisable for me to do what? To dispose the asset, and will I be able to do what? To have been able to recover my investment at the end of that period. So at the end of any year you choose, you have to do what? To consider the net realizable value. So in this scenario in which we are on now, you can do what is advisable for the company to do was to dispose the assets at the end of what? To 1.17 years. So that is what? That is a payback period with bailout factor. Now, under payback period, we have been able to do what? To calculate the number of years in which our return from our investment to cover up our investment. Now, what are the decision rules? Under payback period, we have 3 decision rules. Let's look at those decision rules. Let's look at the decision rules. So decision rules. So 1, if payback period is less than the asset life, the project life, is equal to what? Accept. You do what? To accept the project. Now, if the project payback period is less than the project's life, we accept the project. We accept the project. What am I saying? Okay, let me finish the rules. If payback period is greater than the project life, is equal to what? Reject the project. 3. If payback period is greater than or equal to the project life, is equal to, anyhow, is equal to, let's just get this straight so that now not to confuse anybody here. If the payback period is equal to the project life, is equal to what? Accept or reject, depending on other qualitative factors. Now, these are the decision rules under payback period. The payback period that we are calculating the number of years. And definitely, assets and investment normally have their useful life. Let's say, for example, a machinery, plant and machinery, motor vehicle. Motor vehicle is assumed to do or to have for a useful life of 4 years. So you now calculate the inflow, the payback period. You calculate the payback period for that motor vehicle, for example, and the payback period is less than the project life. Definitely, you have to do what? Accept the project. It means the project is what? It's worthwhile. It's okay. But if the payback period is greater than the project life, you have to reject it because payback period is greater. The asset will have, the project will have expired, will have worn out, before it pays you back. So definitely, it's not. You should reject the project. But in a case whereby the payback period is equal to the project life, you are not indifferent about accept or reject. So you have to consider other qualitative factors. Those factors you are calculating, they are qualitative factors. So in such a case whereby the project payback period is equal to the project life, you have to do what? To consider other qualitative factors. So in the next video, we shall be looking at qualitative factors. What are the qualitative factors that we are talking about today? So by this, we come to the end of payback period. Please, if you have not subscribed to this YouTube channel, kindly click on the subscribe button. I need your subscription. Kindly click on the subscribe button and give it to me. Give me your subscription. Click on the subscribe button and do what? Comment. Put in the comment section. Put your comment. Anything you observe, kindly put in the comment area, and also like our like the videos and share the videos with your loved ones. So watch out on qualitative factors in which will help us in determine whether to accept or reject the project if the payback period is equal to the project life. Thank you for watching and see you next. Thank you.